Hey guys, welcome to the Dividend Growth Machine YouTube channel. My name's Nathan. If you're interested in getting updates for all future videos, click the subscribe button down below. Today we're going to be talking about valuations. Got a question this week from Kim. Kim says, Nathan, I seem to have done well with dividend growth investing, but I just don't pay much attention to value in taking a position. Do you give it importance, and if so, how do you determine fair value? So first off, yes, valuation is one of the most important things, if not the most important thing, when determining whether or not you should make any investment, whether that's a stock investment or a bond investment or even real estate, farm ground. You know, the only thing that matters when making investments is how much return are you going to get, and what's the probability that you actually get that return. So if you're not valuing companies before you buy them, you essentially have very little basis for making smart investment decisions. One thing I will say though is I see this a lot. People, they maybe know that valuation is important, that it's in the back of their minds, that they should be valuing companies, but they're just not really sure how to go about doing that. So today I wanted to just take a few minutes and talk to you about 6 basic valuation principles. And so then tomorrow I'm going to make another video and we're going to talk about what we do with that, right? So how do we take these 6 basic principles and put them into action with a dividend discount model? So we'll go through the specific details of that in tomorrow's video. Talk about how we build a dividend discount model. I'll show you an example with a couple companies, and you'll see all these principles in action. But today we need to talk first about basic principles. So part 1 today we'll talk about, actually it's a video clip from Warren Buffett at the Berkshire Hathaway annual conference a couple years ago, where he's talking specifically about how he thinks about valuing companies. So I pulled out these 6 takeaways from that. So let's take a look. First of all, one of Buffett's concepts for valuing companies is that the only thing that matters in buying a company is what is the future cash flow that this company is going to produce. Now for Berkshire, they're considering buying entire companies. So they can set their own dividend policy based upon the cash flows of that company. You and I do not have that luxury, right? We're dealing with tens or hundreds of thousands of dollars, maybe some of us a couple $1 million, but that's not enough money to really buy entire companies, at least of any meaningful size. So the companies that we're looking at, we're depending on the company itself to pay us something back. So that is obviously the dividend, and that's the whole reason you're interested in this channel is, we talk about dividends. So the dividends is the only cash flow that we're able to get from the stock investments that we make. So what we care about as dividend investors are, what are the future cash flows going to be? And if those future cash flows are growing, then we can be assured that the business that we've got has some kind of value. So if we know all of these future dividend payments, every single one that would ever occur in the future, and we discounted that back at some rate of return, we would know exactly how much we should pay for this business today. Point number 2, what is the discount rate we should use for valuing companies? Buffett says that he uses the long-term government bond rate plus some risk premium. So why would we discount dividends in the first place? Well, if you knew for sure that a stock is going to pay you $100 per share over the next 10 years, and you paid $100 per share for that stock today, how much money are you making on this investment? Nothing. So in order to make some amount of money on your investment, you've got to pay less than $100 today in order to make a profit. So the profit you would like to make on this investment per year is called the discount rate. So if we would discount this $100 back to today at a 10% rate of return for, say, 10 years, roughly we would need to pay, let's call it $50 for this year. I don't think this math is actually right. I'm just making this up. But basically that we know that if we pay $50 today, it's going to pay us $100 in dividends over the next 10 years. You are going to double your money over that time frame. This is an investment, but it's all related to whatever this discount rate is. So Buffett says that he determines what that premium should be by taking the long-term government bond rate, which at this point in time was about 2.04% on the 30-year U.S. Treasury, and then also some risk premium. So the risk premium for stocks long-term has been about 5% on average. Some would argue it's more like 4%, but somewhere between 4 and 5% is generally the amount of money that you have made in addition to the government bond rate for stocks. So, in this particular case, we would say today, as of February 2020, the rate we should get on most stock investments should be somewhere between 6% and 7%. And that's what we need. Now, some companies that are, say, less risky than average, maybe you would be willing to accept more like a 6% return for them, or even 5% if it's an ultra high quality company. Other companies, maybe a highly leveraged energy company or something that doesn't have a very stable business model, maybe you would require more than 7%, maybe 8%, or even 9 or 10 even. So it depends on the riskiness of the investment that you're considering, how much of an additional risk premium you require over the government bond rate. 3, treat stocks like bonds with uncertain coupon payments. So the key difference between a stock and a bond, in Buffett's mind, is that a bond pays you a fixed amount of money ahead of time. So you know that the coupon payments on a bond are going to be $1,000 per year. And you know that in 10 years, you're going to get your $10,000 back. So it's very easy to calculate how much money you would want to pay for this bond because you know what these payments are going to be ahead of time. A stock is not like a bond because you don't know what these coupon payments will be. You don't even know if you'll ever get your money back. Maybe, the company could be on solid footing today, could be growing its cash flows to you, 1,000 this year, 1,200 next year, 2,000 the year after that. But at some point, maybe in year 7, the company may go out of business and may produce 0 coupon payments for you. So there's a measure of uncertainty with these cash flows that you do not have with a bond investment. Number 4, rely only on what the asset produces, which is, in our case, dividends. In Buffett's case, it's free cash flow. Basically, the point is don't rely on stock price appreciation to bail you out, right? So base your entire investment decision on what the future cash flows of the company are going to be. That's where you should ultimately get paid back. If the stock price increases far beyond what you expected, and you're able to make even more on that, and so be it. But the basis for your investment today should be, what are the cash flows coming to me in the future? Number 5, Buffett talks about using ballpark estimates, not perfection. So if you're coming up with calculations that result in a fair value of $37 and 8 cents and rounding it to the 5th decimal point, okay, this is not valuation. Valuation is, we're always dealing in a lot of uncertainty. We don't know for sure what coupon payments or dividends we're going to receive in the future. We don't know for sure what future interest rates will be. We don't know what the true appropriate risk premium is for stocks or this particular stock. There's a lot of things we don't know. What we're trying to do is basically, as Buffett would say, be vaguely right. So it's better to be vaguely right than precisely wrong. So when you're working on valuations, again, give yourself, just think in ballpark estimates. If you come up with a valuation of say $45 and the stock is trading for $44.50, okay, this is close enough, right? You don't need to wait for the stock to fall below a certain value. You don't need to wait for it to I'm sorry, this was backwards. Say you came up with a fair value of $44.50 and the market's trading at $45. You don't need to wait for the stock to fall 50 cents to buy the stock, right? It's close enough. It's roughly fairly valued. So what I would probably do is just think about, whatever valuation number you come up with. Maybe you'd say, plus or minus 10 or 15%, anything within that range, you're going to consider to be a roughly fairly valued company. I think that would be a decent range to think about. So in your example here, $44.50 is your stock price, what you came up with. Maybe you'd be willing to pay anywhere between what would that be, about $49 and about we'll say anywhere between 39 and 49 would be a roughly fairly valued stock in your valuation estimate. And finally, focus on businesses with stable cash flows that you can understand. And I'm going to circle you here. So Buffett focuses on companies that are pretty boring. So his portfolio is Coca-Cola. He's got the Washington Post. Moody's is another one that he owns. Marathon Petroleum, Apple. So all these companies are, maybe at some point they were an exciting growth stock like Apple, but for the most part, these businesses are extremely stable. They have extremely stable cash flows. Even Apple, it's thought of as an innovative technology company, but really they're mostly selling iPhones, and that's almost a consumer staple need at this point. A lot of service revenue, things like that. So it's companies that have stable cash flows that he can understand. So for you, maybe your circle of competence is not what Buffett's is. So Buffett focuses a lot on consumer staple companies. He's famously not interested in many technology stocks because he says he can't understand them. He doesn't know how certain the cash flows are going to be because he doesn't understand the business well enough to assign any decent amount of certainty to his estimates. So focus on areas of the market that you specifically understand pretty well and you feel comfortable that whatever estimates you make for the future dividend payments are going to be within some ballpark of what they actually end up being. Obviously, you're going to make some mistakes along the way. That's okay. But by focusing on areas that you personally can understand, that's going to help you a lot in making your valuation decisions. So that's it. I hope that was helpful for you guys. If you liked this video, click the thumbs up. If you want to get notified of future videos, hit the subscribe button down below. And if you'd like to ask a question for me to make a video on possibly in the future, leave a comment down below or send me an email. I always love hearing from you guys and I appreciate the dividend community. So let me know what you think. I hope this is helpful, and we will see you tomorrow for a video on how to use and build a dividend discount model.